The Japanese yen has just crossed a Rubicon, plummeting to its lowest level against the US dollar since 1986. With US dollar to Japanese yen shattering the 160.50 resistance, we are witnessing a historic short squeeze. By the end of this video, you will understand why the Bank of Japan's interventions are failing and what the Fed's 85% hike probability means for your portfolio. Why is this happening now? The primary driver is a stark divergence in monetary policy. While Japan maintains a cautious stance, recent hawkish comments from the Federal Reserve have sent shockwaves through the currency markets. This isn't just a minor fluctuation. The break above 160.50 has triggered a massive technical short squeeze, leaving previous BOJ intervention levels in the rearview mirror. We are now in uncharted territory for the modern era. Let's look at the hard data. US dollar to Japanese yen closed at 160.88, a level not seen in 40 years. Markets are now pricing in a staggering 85% chance of a Fed rate hike by December. Historically, the last time the pair traded at these heights in July 2024, the Ministry of Finance deployed approximately $35 billion in intervention over just 2 days. However, the current momentum suggests that even a $35 billion bazooka might not be enough to stop the bleeding this time. On X, the sentiment is electric. Traders are pointing out that the BOJ's previous interventions are effectively failing to hold the pair back. Some analysts are highlighting that we just saw the lowest yen close since 1986, which is shifting the narrative from a temporary dip to a structural shift. There are even reports that the Bank of Japan may have conducted early-stage intervention signals right before the close, suggesting they are desperate to prevent a further slide. Professional strategists are sounding the alarm. The consensus is that the Fed's hawkish bias is creating a vacuum that the yen cannot escape. When the Fed signals an 85% probability of a hike, the interest rate differential becomes too great for intervention alone to solve. Without a fundamental shift in BOJ policy or a cooling of U.S. economic data, currency traders believe the path of least resistance for US dollar to Japanese yen remains firmly to the upside, despite the risk of MOF action. Paradoxically, the weak yen is fueling a massive rally in Japanese equities. The Nikkei 225 has surged above 70,000 for the first time in history, hitting a record 71053. This AI-driven rally added 28.6 trillion yen, roughly $173 billion, in a single session. Technology stocks remain the key drivers, attracting massive global capital flows as investors play the weak yen. Strong tech exports trade, pushing the TOPIX to 4,068 points. The rally isn't limited to Japan. Asian markets surged following reports of a potential US-Iran ceasefire deal, which has significantly boosted global risk sentiment. The Kospi rose 1.8%, and the Nikkei's 2% jump was bolstered by this geopolitical de-escalation. This risk-on environment, combined with the Fed's hawkishness, is creating a unique perfect storm where equity markets climb on optimism while the yen falls on interest rate reality. For individual investors, the priority is risk management. Monitor Fed communications and BOJ actions closely, as the 160.50 level has transitioned from resistance to a potential new floor. Watch for the intervention looms narrative. Any sudden move by the MOF could trigger a volatile sell-off similar to July 2024. The key is to distinguish between the long-term trend of yen weakness and the short-term volatility caused by government market participants. Looking ahead, we see 3 primary scenarios. In our base case, US dollar to Japanese yen consolidates between 160 and 162 as the market awaits the December Fed meeting. The bullish scenario for the yen involves a massive $50 billion intervention combined with a Fed pivot, potentially dragging the pair back to 155. Conversely, our bearish scenario sees a breakout toward 165 if the 85% hike probability hits 100% and the BOJ remains passive. Watch the 160.88 close as a critical benchmark for the week ahead. The yen's collapse to 1986 levels and the Nikkei's rise to 71,000 are two sides of the same coin. Remember these three things. The Fed's hawkishness is the primary driver, 160.50 is the new critical level, and intervention risk is at an all-time high. If you found this deep dive helpful, subscribe to Tokyo Macro and hit the notification bell. Let us know in the comments, is the Nikkei 71,000 sustainable?